Hey everybody, welcome to Dividend Stockpile. So over the last few months, more and more investors, myself included, are considering looking beyond the United States for some investment ideas. This sentiment has been confirmed by the outperformance of international stocks compared to US stocks so far this year. For instance, VYMI, which is a Vanguard International High Dividend Yield ETF, is up over 17% this year, where a fan favorite SCHD is actually down for the year. So that is just one bullet point and one data point of the difference between how international stocks are performing this year compared to U.S. stocks. So it definitely shows that some people are very interested in diversifying beyond the United States, whether that's because of politics or because of valuations or whatever, but people are looking outside the United States. So as I was thinking about that, I was trying to figure out who would be the number one resource to reach out to talk about some unique international dividend stocks. And of course, my guest today, Derek, was my number one choice. So for those who don't know Derek, he's a fellow YouTuber. He runs a podcast, and he also has a blog that you can visit. He is currently the co-host of the Dividend Talk podcast and YouTube channel, where their tagline is your number one podcast for all things dividend and stock market related, with a unique European flavor. So with all that, I wanted to welcome Derek to Dividend Stockpile. How you doing?
Thank you, Jeremy. It's an honor to be here. Thanks so much for having me.
Absolutely. As I said, you were my number one choice of who I wanted to talk to when it comes to European investments, specifically dividend investments. I was on your guys' podcast many years back, and we've communicated, on X and on Facebook groups and things like that. So I'm really happy that we were able to connect, talk through some unique European stocks you have for us today, and kind of get a little bit of background on yourself. So I guess we'll start there. Can you tell everyone a little bit about yourself and then how you became a dividend investor?
Perfect. Yeah. So my name is Derek. As you mentioned, I co-host the Dividend Talk podcast with my buddy European Dividend, which started during COVID. Everybody remembers lovely COVID. We used to speak online quite a bit, and then we met. And after maybe one or two times, hey, if we're European, we like talking about stocks. Maybe there's other Europeans that will enjoy talking about it, interacting with it, so we can build some sort of community. So we kind of bit out from there. But if I was to go back before that, my investment journey started a little bit more of a trading, maybe more of a trading lifestyle than investing. It was sports trading first, which I don't know if you have over in the US, but you can go onto a sports book and make bets. You can win or lose based on laying or backing horses, basically. I went from there. I wanted to go into the financial world, and obviously with my trading background, I like to trade stocks. That didn't work too well. So I kind of like to branch out, and in Ireland, it's difficult because property is probably the biggest investment that you can do over here. Lots of people do that, and there's lots of things about taxes and one with investments. So I tried ETFs, but we have this weird disposal rule that you have to pay tax every 8 years. And eventually found dividend investing. Honestly, I think ever since I received that first dividend check, I've been like most.
Yeah, I definitely think that's how it goes, is like you stumble across dividend investing, and then you realize how powerful it can be, and then some people just get hooked to it, like you said, like I definitely did. So yeah, it's great. So how long have you been dividend investing?
Since 2017, it was quite long, actually. I don't think it's that long, but yes, since 2017.
Yeah, time has definitely been weird over the last couple of years. Like it doesn't seem like time's passed, but it really has. So going back to the ETF thing, so Ireland has a limitation or a tax on ETFs?
Yeah, we have this tax. It's called deemed disposal. So if we hold and accumulate an ETF, basically every 8 years we have to pretend to sell that, even if we don't, and pay the tax on the gains as if we sold it. So obviously the downside of that is the compounding that you get from holding is affected because you pay the tax. And honestly, it was just an accounting nightmare, so I didn't want to go down that route.
Yeah, so now I understand why you're an individual stock investor after all that. Yeah, that would not be good. I'm glad we don't have to worry about that over here. Okay, so obviously, listening to you and following you for a long time, you guys invest both in European stocks as well as U.S. stocks and maybe even Canadian stocks. What do you see is the biggest difference between dividend payers in Europe compared to dividend payers here in the United States?
Yeah, I mean, one of the biggest things that I noticed is the dividend policy. So we all know that U.S. companies actually prefer to pay dividends or they prioritize dividends. But they don't actually state that. If you go into any European company's investor relations, most of the time you'll find a definitive dividend policy. And it will usually say something like they pay out 30 to 40 or 50% of earnings. So while they will prioritize it, it will only be if earnings are growing. And I think that's quite refreshing because I know where it stands. If earnings are growing or not growing, where my dividend should be.
Yeah, that's interesting because here in the United States, if we had a company that had a variable dividend policy like that, where it's based on, earnings or cash flow or whatever happens to be, everyone would like criticize them or sell them off because they're not being stable. Something about U.S. investors, we love our quarterly dividends and we want to just stay the same and then grow every year. So I think it would be a big awakening for a lot of U.S. investors if we had a variable dividend policy like you. But that being said, it actually probably does make more sense to have a variable because you get a portion of the earnings or a portion of the profit of the company, as opposed to continue paying that dividend, whether you can afford it or not. And how many U.S. companies have we seen that their payout ratios get so high or their debt payments are too high and they have to cut the dividend? So there's definitely something to say about having the variable. That's interesting.
It also makes you focus more on companies that are growing their business or their earnings, their revenue, their free cash flow. Because we're going to talk about some companies, but L'Oreal, for example, that paid dividends for 61 years, but they've increased it for 61 years. So even though it's a very well dividend policy, good, strong companies will continue to grow for decades, just like US companies.
Yeah, that actually makes a lot of sense. Now, what I've noticed a lot on European stocks is they do two dividends a year typically. They do like one standard and then one based on their results of their earnings. Is that kind of how the game behind it? Okay.
Yeah, so you kind of have an interim dividend, which might be a flat rate, and then the remainder of that, a final dividend would be based on the performance, and that's where you see dividend growth.
Yeah, that's quite interesting, but I actually like it. I think if you can get over the fact that it's not always going to be consistent, just know that going in, good approach.
And what it means is in May, June, and July, which are the main months to pay it, my dividend income skyrockets to the other months.
So their fiscal year ends, and then that's when they decide how much money they had, and then that's the next dividend.
Exactly. That's the end of that.
Awesome. Well, okay. So since we're talking about stocks and dividend stocks and how European stocks companies do, you brought some unique, high quality European dividend stocks to talk about. So for those people here in the United States that have access to U.S. Brokerage companies, I'll be sharing the U.S. tickers. And Derek will, of course, talk from a European perspective. So, Derek, let's go and start off with the first one. What do you got for us?
Yeah, I think I've mentioned already, which is L'Oreal. I refrain from using European tickers just not to confuse the audience. I mean, L'Oreal's a company you might be aware of, but they own brands like Lancome, L'Oreal Paris. It's a huge luxury brand based in France. And one of the main markets is obviously China. With the Chinese kind of tensions at the moment, it has impacted them slightly, but they've had some strong dividend growth, looking at 10% plus over the last 5 and 10 years. The only downside this year is around 1.8%. So this is a low company. But for a European company, it's at 61 years.
Yeah, that's amazing. So having a little bit under 2% current yield is definitely for those people who are not needing the money right away, but that 5-year growth of over 10% or whatever it is, that's pretty strong. So you can definitely do well with that over time, but it definitely is a lower amount right now. Now, I know at least here in the United States, we have a very popular brand called ELF, Eyes, Lips, and Face, and they're known to be top quality and lower price. How do you see the competition in the cosmetic space affecting L'Oreal?
So L'Oreal own hundreds of brands. Got some brands that are kind of lower priced, some that are middle range and high range. They've got such a broad portfolio that they take up nearly most of the market. I think that market number one in the US, Europe, and Asia, that portfolio is so big. So I do understand there is competition, but they've got so many brands that will kind of soak up that competition and continue to grow.
Yeah, and that's really interesting how cosmetics work. And obviously, even guys, we don't typically use cosmetics ourselves, but of course we have, women in our life or whatever. But I've noticed that even when there's economic downturns or economic situations, people still buy cosmetics. It seems like it's a constant thing no matter what's going on. Yeah, they might lower their price point at a certain point, but I think once you get comfortable with the brand, you like how it feels, that type of thing, you tend to stick with it. So with L'Oreal being around for so long, a lot of people are loyal to that brand.
Yeah. Everybody wants to feel good, look good, and they get used to that kind of lifestyle already. Look, and I think COVID really surprised me. I wasn't expecting to grow so strong, and they were growing double digits, whole lot. Them, that's when you know it's a quality company with price and power.
Yeah, definitely. So looking over some of the details. So the US ADR ticker is LRLCY. So they're going to sound weird, but that's just how ADRs work.
Yeah.
5-year total return is about 65%, which comes out to a little over 10% total return each year. As I said, the dividend is just under 2% with a 10 to 12 dividend growth rate on average. So that's definitely a good quality company. He said they've been paying a dividend for multiple decades now. And it's their products are at a price point where even if there's economic hardship, people are still going to buy their products, because they're just so used to it and it's a lower price point. We're not talking about $200, $300 or anything for an item. You pick something up for $10, $20, things like that. So it's a lot easier for people to continue to have access to, cosmetics. Yeah, that sounds good. And I like you were talking about how they're focused on China right now because, as China progresses on the economic scale, there's more people moving into the middle class lifestyle. They're going to start using more cosmetics. So that's a good growth engine for them.
Yeah, cool.
Is there any kind of negative that you kind of think about when it comes to L'Oreal? Anything we need to be looking out for?
Yeah, I mean, the negative is really China at the moment. I know that's kind of a headwind, but at the moment with the tariffs, and there's a lot of uncertainty, particularly Europe, China at the moment. So it is impacting them. We're not overly concerned. Honestly, it just creates a buying opportunity for me. This company has been doing well for the last 60 years. So I don't really anticipate it being slowing down.
Yeah. Yeah, it seems like it's one of those kind of evergreen companies that's always going to do well and always going to be in demand. All right, so let's move over to your second choice for today.
Yeah, it's one that's very close to my heart. And then I'm an automation engineer. So I picked Schneider Electric, which also happened to be a French company. Now, don't worry, it won't all be French companies, but Schneider Electric are quite a strong company as well. So you might be familiar with Rockwell Automation over in the US. These are of a similar make it then. They do PLCs, they do industrial automation, but they're also heavily involved in this energy management and trying to get on the back of this kind of energy transition to renewables. So that's the real big. And again, it's a low yielder, 1.82%, but the decline goal is consistently about 8%. One thing I didn't met Laurie yet is that you register your shares with a French company, just for French companies. You're eligible for an extra 10% dividend. That's if you register new shares with the company, which is quite a good.
Yeah, it's pretty neat.
Yeah. But what I liked about Schneider is that I'm really big into energy transition. Schneider will get the center of that. Also, industrial efficiency, the capital out. They have high returns. So I think it's a perfect mix. And it's, as I work in the area, it's one that I'm very passionate about. So it's a great goal in 10 years there.
That was awesome. And that's definitely been one that's always been on my short list of potential buys in the future. I really, obviously I love what they do and the line of business they're in. The energy transition is such a huge opportunity for so many companies. And so Schneider is able to use their products to ride that wave of the, greener electrical revolution. I know the green movement is definitely bigger in Europe than it is in the United States at this point, but times will change, and a lot of the lowest cost energy is renewable energy. So there's a good future ahead of them. So that's definitely always been on my short list. The US ADR is SBGSF. Again, it's a mouthful, but one of the things that really impresses me is their total return over the last 5 years or so. I think they're averaging like 23% a year on average total growth. That's amazing. I mean, that's huge compared to SCHD or some VYM, like all these other dividend ETFs that we have over here. So, I mean, that's,
Yeah, they've
that's
you took some time to kind of transition. They were repurposing the brand and focusing really on this energy transition, electrification, data centers, and they spent about 4 years doing that. We're starting to see the fruits of that now with the returns. I don't see it going down over the next 10 years.
yeah, with all the industrial things that people are like that industry is growing. You have the power generation, you have the transition to renewable energy. There's so many things that they can be involved with. So I think they have a long runway ahead of them for sure. Do you know how long they've been paying a dividend off the top of your head?
They haven't cut a dividend in 19 years.
Wow,
Right?
that's good.
So I think in Europe, that's the difference. You notice I didn't say it increased it every year. They haven't cut their dividend.
Yeah.
That's how we be.
But I mean, the combination between total return and the dividend growth, I mean, it's a good package. I said the dividend's like 1.8 or so right now. 5-year dividend growth, according to Seeking Alpha, is 9.5% on average. And then that total return of 23.5% a year. I mean, you really can't ask for anything more when it comes to dividend growth stocks. So that's really great to see. All right. So the next one you have on tap, I personally own. So I'd be interested to see your take on it. So Novo Nordisk.
Yeah,
Building it out.
I think everybody Novo Nordisk as in Slatro or Ozempic. They've been the number one in that category for a long time. Based in Denmark,
Okay.
it was known primarily for diabetes. And I think that's what I like the company for, more so than Ozempic and all these other stuff. Diabetes affects millions and millions of people. Quite, there's a huge market. But again, we look at that with your dividend, it's around 20% plus. They have been growing their dividend for 3 years. Dividend yield is 2%. Overall, it's a strong company. There is some competition from Eli Lilly. Their CEO stepped down last week. I don't know if you heard that. So there's some pressures in terms of the share price. But I mean, I think in terms of diabetes, there's a market there. You think of this weight loss drug, there's an unlimited supply there. So I think plenty of growth.
Yeah, I think there's still plenty of people who haven't gone on those Ozempic or this have a weight loss medication. They're continuing to find benefits of people using them. And to your point, it originally started off as diabetes, but now it helps with obesity and all the circulatory stuff that happens in your body. Like they have a lot going for them. So on their official list, they do diabetes, obesity, rare disease elements. So they continue to innovate, coming up with new products, blockbusters like Ozempic. And so it's one of those things where we can definitely continue to see some growth. And one thing that I did notice is that the stock price this year has gone down quite significantly. I think that's what is piquing a lot of people's interest. I think it's something like 40 or 50% down this year.
Yes, it's gone down quite big. And it's one of the reasons the CEO had to get down. But you've got a lot of competition coming up like that GLP space is really interesting, isn't it? Competition it's a funny picture of that. But
yeah. And they clearly have a global market, but here in the United States, at least, there's a lot of uncertainty with the current administration of the drug policy and costs and things like that. So there's a lot of headwinds. But for such a strong company that's been operating for so long, more than likely this is just a temporary blip, and it gives you a good opportunity to buy shares at a pretty good price. So I've been adding every couple of weeks a few shares here and there, and just waiting for that turnaround. And in the meantime, I'm collecting the dividend and then stocking up so that once it does take back off, I'll get all that benefit from it. So definitely a good quality company to pick.
I think so, yeah. And it's a good moment to buy them. It's just that there's so much uncertainty with tariffs, with pharmaceuticals, and now with competition. So yeah, I think it's a nice time to buy them.
Awesome. Okay. So what's your next one you have for us?
So the next one is a bit of a note. The Dutch company, and they are called Koninklijke Apold Delhaize. But basically, it's the Dutch consumer staples. It's like a big supermarket brand. You might know some of the brands in the US, such as Food On. Yeah. So actually, US holds quite a big market for them. It's around 30 and 40% of their sales. So it's a big market. It's just maybe brands you might not have heard of. Yeah. Again, it has a really strong history of dividend growth. It's done 16 years of dividend growth.
Okay.
Its 5-year dividend was 11%. You get a good yield, it's 3.7%.
Yeah, it's definitely a strong balance. That 3 plus 7 is like the perfect spot. 3 when you're anywhere in that combine them 10 to 12 range, that's like a real good quality spot. And you get a higher dividend right now for those who need the income sooner than later. But yeah, to your point, in the U.S., it's Stop and Shops, Food Lion, Giant, Martin's, Hannaford, Giant Food, Teapot. So I know of Food Lion. There's some of those in my local area, but the rest of them I hadn't heard of. But I'm sure, throughout the country, they have those regional grocery stores and supermarkets that everyone's used to. So I mean, obviously groceries is a staple. Everyone needs their groceries. And so, they have a really solid foundation to build off of, going forward and continuing to paying that dividend. So I know the stock price has done really well. Is the business expanding? Is it increasing their sales?
Yeah, the stock price, I would say they're probably a little bit overvalued at the moment. I have them priced a little bit lower. They are expanding quite well. One thing I will say is very shareholder friendly. They would have bought shareholder with share buybacks. So see they on 1 billion repurchase program over 1 or 2 years. They do special dividends every now and again. And as I said, they have a solid dividend.
Yeah, they
growth rate.
So outside of the United States, do you know which European countries they're big in, or a couple at least?
Yeah, Belgium and Ireland.
Oh, sorry.
I live in Ireland.
Yeah. None there? Okay. Well, if you ever travel to some of the other countries in the area, you can stop by and say, I'm a shareholder or whatever. So,
yeah, I'm in there. Another shareholder job.
Oh, that's awesome. All right. So for everyone in the U.S., ADRs, ADRNY, the 5-year total return is a little over 100%. So it's averaging about 15% a year. As you said, the dividends in the mid threes with the dividend growth, that 8 to 9% range. And, consumer staple, people need the groceries. They're always going to go buy it. So if there's one in your local town, you probably visit it. And, you spend, if it's anything like my family, we spend hundreds of dollars every week in the grocery store because I have 2 teenage boys. So, it's something that people are going to need forever. So that's definitely a good, stable, quality dividend and also a growing company over time. And I love the fact that you mentioned they're shareholder friendly. That's definitely a big part of it. You want to be aligned with the manager and you want to have the management aligned to the owners. So if they come out and talk about it and back it up with their actions, that's a really good sight to see. All right. So I think you have one more for us. So let's wrap it up. Which one?
Yeah. This time I'm taking you to Germany and it was Siemens. So Siemens are quite a large company over here, but I've done everything: automation, security, infrastructure. You can have a health business that is spun off. I mean, it's a pretty big conglomerate.
Yeah.
So I have them at around €100 per share. I think the share price is at €200, so it's not the Dublin price. But you get at the moment, you're at a 206% dividend yield, which is still quite good. Beginning CAGRs on the close about 5%. So typically I would want the yield to be a little bit higher. That's slower growth. But what you're getting is a company that is growing their dividends year on year. There's a slight cut in 2020, the CAGRs, and during overtimes, it's growing with every years.
Yeah. Siemens is big here in the United States. The city that I went to college in had a huge facility right there by the campus of our college or university. Siemens, for a while here, I don't know if it still is, it was called Siemens Westinghouse. I think it was like a joint venture or something they had. But yeah, Siemens is a very well-known company over here. To your point, they do digital industries, smart infrastructure, mobility, healthcare, financial services. They got their hands in almost everything.
Yeah, absolutely everything.
Yeah, so looks like total return over the last 5 years is about 170%, averages about 22% a year. To your point, the dividends in the mid twos, the dividend growth rate is around 5%. So to your point, it would be nice for it to be higher. But, if the stock price has gone up so much, you said it doubled and in the last 5 years it's over doubled. And so, maybe when the price comes down, if it does, it might be a good balance to get maybe a 3% dividend or 3.5% eventually. That'd be really nice to see. In Europe, at least, what are they mostly known for? I know they do a little bit of everything, but what would a typical European think of them as?
So what I think of them as an engineer, thing like the Schneider Electric, I've used them in industrial automation, digital PLCs, but they're also heavily involved in infrastructure. Again, we talk about this green transition, and a lot of their products they use. So I think they've done really well to take advantage of this Internet of Things or Internet 4.0 to propel the future. But yeah, digital industries is what I know them for.
Okay, awesome. No, definitely is a very strong name. I mean, as I know it over here, and it seems to be really big in Europe as well. I'm sure they're all throughout the world. So Siemens is a good one. The US ADR for that one is SIEGY. And so if you're here in the United States, that's the ticker you want to look at to get access here on US brokerages, at least. If you have access to the European market or your brokerage, of course, you can go with their regular ticker symbol, depending on which market you want to go to. All right, so those are 5 really great European dividend stocks, very high quality, done very well for their shareholders over time. And, they're the classic dividend growth stocks mostly. So I love to see it. So just as a quick recap of what we talked about today, L'Oreal was the first one, Schneider Electric, Novo Nordisk, Ahold, how do you say that one? Ahold?
Ahold Delhaize.
Delhaize. Okay, got it. And then Siemens was the final one. So Derek, thank you so much for coming on and sharing a little bit about your knowledge of some great European dividend stocks that we can at least consider here in the United States. Obviously none of this is investment advice. You want to do your own research, make sure it fits for your risk tolerance and what you're looking for out of an investment. But to get your research started, these are some great options to pick from. Top quality. I knew you would come with some great ones, so I really appreciate it. So before we wrap up, is there anything you want to talk about on your Dividend Talk podcast or YouTube channel? Anything you can share?
Yeah, of course. If you're interested in European dividends, we've got a website. I would recommend checking out europeandgi.com. Obviously, we have the Dividend Talk podcast, and I'm on YouTube sharing my thoughts. I'm trying to break into the YouTube, so feel free to follow them.
Yeah. What I love about your channel is you do have those shorter videos where you go into specific stocks that you're thinking about or your total performance of your portfolio, but then you guys also cross-post your podcasts there too. So you can listen to the long form with you and European DGI talking about in depth about some different topics, news that are coming up in the industries, dividend cuts, dividend raises. You guys talk through it all. And I love your approach to it because you don't hold back. You guys tell it exactly how it is. So if a company messes up, you'll put them out there and tell them. So I love the style. I've been listening to you guys for years at this point. So I really appreciate all your work you have over there. So definitely, guys, go check out Derek's work. I'll put all the links on the page here and in the description below. Definitely give it a follow, give it a like, subscribe, definitely on the YouTube so they pump that up as well. Derek, thank you for joining us. I know it's late over there. Really appreciate your time and glad we could get this together. Thank you for coming on, and we'll talk real soon.
Thanks for having me.
All right, thank you.
Well, Stan. Bye-bye.